So, there's a CFO somewhere in San Francisco, probably wearing the very wool sneakers his company is about to sell off for parts, and he's staring at a $21 million market cap on his Bloomberg terminal. This is Allbirds, the eco-friendly shoe company that IPO'd at $4 billion in 2021, the one that promised to save the planet one merino wool moccasin at a time, now trading like it's already been delisted. Revenue cratered from $298 million in 2022 to $152 million last year. So this CFO does what any reasonable executive in 2026 would do. He sells the entire shoe business, the shoes, the brand, the IP, the whole reason the company exists, all of it dumped on a holding company called American Exchange Group, the people who own Aerosols and Ed Hardy, for a sad little $39 million. Then he takes the empty husk of a public company that's left and renames it NewBird AI, and then announces with a straight face that NewBird AI is going to buy GPUs. That's it. That's the plan. There's no data center. There's no power purchase agreement. There's no customer. There's no engineer. There is a press release, a $50 million convertible note from an undisclosed institutional investor, and the letters A and I sitting at the end of the company name like a fresh coat of paint on a condemned building. And the market, the supposedly efficient, rational, price-discovering machine, looks at this and goes, "Hell yeah, brother." The stock pumped 876% intraday. Closed up 582%, $3.87 billion in shares changed hands in a single trading day, which is more volume than JP Morgan and ExxonMobil saw on the same day. JP Morgan, the bank, was outtraded by a sneaker company that just stopped being a sneaker company. And here's the part that should make you feel something. Allbirds was founded in 2015 as a public benefit corporation with a charter built around environmental conservation. As part of this transaction, they filed paperwork to formally remove the environmental conservation language from their corporate charter, because the new business, you see, involves running power-hungry chips that draw 700 watts each in giant cooled buildings. So they are literally amending their constitution to be allowed to be worse for the planet in order to LARP as a data center. And look, this is not a one-off. There's a karaoke machine company called Algorithm Holdings that pivoted to AI trucking logistics in February. There's a Chinese insurance broker called Masse that's now a full-stack AI player. The 2017 Long Island iced tea pivot to Long Blockchain Corp is the literal template for this maneuver, and that one ended in an SEC investigation and a delisting. Now let's do the math, because the math is incredible. $50 million at current Blackwell rental rates of $4.08 an hour, which by the way spiked 48% in the last 60 days, buys you roughly 1,000 to 1,500 H200 GPUs. Microsoft is doing $150 billion in annualized CapEx. Amazon is at $200 billion this year. The four major hyperscalers combined are spending about $700 billion on AI infrastructure in 2026. NewBird AI's $50 million represents 0.007% of that. It's not even a rack. It's like showing up to a Formula One race with a Razor scooter and demanding a podium. And the Blackwell GPUs they want to buy are getting replaced by NVIDIA's Vera Rubin architecture in the second half of this year, with 10x the performance per watt. The assets NewBird is buying with that $50 million will be functionally obsolete by Christmas. Even CoreWeave, who has a real $66.8 billion backlog with Meta and OpenAI, lost $1.17 billion last year. The unit economics of GPU leasing are brutal for people who actually know what they're doing. NewBird does not know what they are doing. Bill Clayman, who actually runs an infrastructure company, said Allbirds lacks the necessary expertise, physical assets, power agreements, and cooling strategies required to compete. Translation, my man, you sell shoes. So who actually wins here? Not retail, not the workers, not the planet, obviously. The convertible note holder wins. They lent $50 million, and they get to convert that loan into equity at a discount, which means when the stock pumps, they exit. When the stock crashes, they're still senior to everyone else. They get paid whether the GPUs ever ship or not. It's the SPAC playbook with NVIDIA branding. And meanwhile, Sequoia just raised $7 billion, and Axel raised $5 billion targeting late-stage AI with nowhere to deploy it because 65% of last quarter's VC dollars went to just 4 companies. And then look at C3.ai, the original publicly traded AI play. Down 40% this year, revenue collapsed 46% last quarter, and Executive Chairman Thomas Siebel just dumped 491,467 shares on April 13th and 14th for $4.1 million. That is a man with information you do not have, walking calmly toward the exits while you watch the news. I want you to internalize what happened on the NASDAQ this week. A market doesn't pay 876% for a business. A market pays 876% for the announcement that a business has stopped being a business. The shoes were the only real thing this company ever made. They sold them for the privilege of being a ticker symbol with vibes. We are no longer in a market that funds operating companies. We are in a market that funds the press release of an operating company, and the gap between the press release and the reality is where your retirement account is going to disappear. Thanks for watching.